Hi, this is Anthony Parent of Parent and Win LLP, the IRSMedic, and in this video I'm going to be talking about offshore voluntary disclosure programs when you have a corporation, trust, foundation, or partnership involved. And our first question is, does it matter if your foreign accounts are held in the name of a company, corporation, or trust, or some sort of entity? And the answer is absolutely. It really does. And so let's talk about some of the first. Let's talk about some of the first ones. Let's talk about OVDP for a U.S. company, trust, foundation, or estate. If the foreign financial accounts are held in the name of a U.S. company, trust, foundation, or estate, that entity needs to file its own FBARs. If it hasn't been doing so and the income from the foreign financial accounts has not been properly declared, then it is this entity that needs to participate in the OVDP. And what options are available depends on what type of entity it is. So let's talk about OVDP for a U.S. corporation or partnership. If a U.S. corporation, and either S Corp or C Corp, or a U.S. partnership has its own FBAR filing requirements, it has to go through the OVDP itself. The reason why is because the income comes in the company's name, not the individual partner or shareholder. The company will not be eligible for a streamlined OVDP. If the partners or shareholders have their own foreign accounts, they would need to enter the OVDP or the appropriate streamlined program in their own name as well. If the partners or shareholders are simply listed as signers on the company's accounts and have no previously undeclared foreign accounts on their own, they can likely just file amended FBARs with an explanation of why this account was not declared previously under the IRS guidelines. Now, what about OVDP for U.S. single-member LLCs? If you are the sole owner of a limited liability company, that is reportable on your Schedule C. And that LLC owns foreign financial accounts, it has its own FBAR filing requirements, even though it does not have to file its own tax returns. If your LLC has its own bank accounts, it is likely that you would have signatory on those bank accounts, and therefore both you and the LLC would need to file FBARs. For an LLC that's reported on the Schedule C of an owner's tax returns, bank interest and capital gains transactions are taxed as if they belong to the owner. Therefore, this kind of income would be reported on your Schedule B or your Schedule D. If you did not properly report the income for these foreign sources or did not properly file FBARs for you and the LLC, then you would need to go through the Streamlined OVDP program or the relevant Streamlined program. The LLC would not need to go through the program itself. If you properly reported the accounts on your tax return but did not file FBARs, again, for you or the LLC, it is likely you will just be able to file delinquent FBARs under the IRS's guidelines. And let's talk about offshore voluntary disclosure program for U.S. estate. If U.S. estate has foreign financial accounts, it probably has its own FBAR filing requirements. The trustee of the estate is required to file these for the estate. He or she likely has his or her own FBAR filing requirements with regards to the same accounts. If these foreign accounts produce income that was not declared on the estate tax return, the estate would need to participate in the OVDP. The estate may be also eligible to participate in the relevant Streamlined program. The trustee would likely qualify, again, if there's no income, the trustee would also likely to qualify for no delinquent FBARs or if the trustee has no income, then we could just file missing FBARs under the IRS's guidelines, unless the trustee had income from these accounts that should have been reported on the trustee's own tax return. Now let's talk about OVDP for trust. If a U.S.-based trust that is not a grantor trust, that's a little special thing, we'll talk about that a little below, has foreign financial accounts, it has its own FBAR filing requirements. The trustee is responsible for filing these FBARs and the trust tax returns. The trustee also likely has his or her own FBAR filing requirements for the same accounts. If these foreign accounts produce income that was not declared on the trust tax return, the trust would need to participate in the OVDP. The trust would not be eligible to participate in a streamlined program. Now, when we talk about grantor trusts are trusts that are set up by a person who contributes money to the trust but retains substantial control over this trust. This is a common method of creating a trust during your lifetime for the purposes of passing on the assets held within the trust to your beneficiaries after your death. For U.S. tax purposes, this trust is disregarded. It must still file a trust tax return each year, but it does not report the income of the trust on the return. Instead, the grantor, the person who established the trust and retains control over the trust, reports the income from the trust on his or her own tax return. If a grantor trust has foreign financial assets held in the name of the trust and the grantor have their own FBAR filing requirements. If the foreign financial accounts produced income that was not reported on the grantor's tax returns, then the grantor would have to go through the OVDP or relevant Streamlined program under his or her name and file FBARs for both the grantor and the trust through the relevant program. We're almost done here, I think. Okay, now let's talk about OVDP for a foreign company, trust, foundation, or estate. In each of these situations, the person who is a U.S. citizen or resident who has a financial interest in a foreign financial account that the company, trust, foundation, or estate holds and did not file their own FBARs declaring the interest in that account would enter the OVDP or a Streamlined program in their name. Disclosure forms would need to be filed based on their ownership interest in the company, trust, or estate with the IRS during the individual's disclosure under the relevant program. If the entity involved was open solely to avoid disclosing the ownership of the account or for tax avoidance purposes, this can impact your ability to participate in the Streamlined program and can negatively impact your case if you attempt to opt out, but it's not fatal at all. In fact, many accounts open overseas are opened with trust foundations, alter egos, and many people did not know what the bankers were doing. They just thought that is how it's done. I know that from experience. So that is not fatal. It just could be a negative impact, something you definitely want to watch out for. So that's it. That is for your OVDP for all types of entities that are not individuals, both foreign and domestic. This is Anthony Parent of Parent in Win LLP. I thank you for watching, and please subscribe to this channel so that you can get informed of the latest updates. Thanks for watching.